In this video, I will be using Heikin Ashi, Fibonacci retracements and RSI to cover how to make the most out of a price drop. And in the end, I will also share examples from my own trades to set up positions following an earnings drop. First of all, when we see a price drop, which is usually after an earnings release, it is important to not panic. In swing trading, this moment can often be an opportunity for potential returns. But how does it actually play out? Just before the results, a good stock would see a potential bullish run, usually driven by optimism amongst retail investors, and maybe a consolidation just leading up to the point of results. And then, in some of those cases, comes the price drop. Now, the investors who had been buying leading to this point are usually left confused on what to do with their positions. For this video, I will be using Texas Instruments as an example on a daily time frame. As the price drops, it's hard to tell at first where it's going to move next. Will it continue to slide lower, or is it going to rebound right away? This is exactly where I start my analysis. My first step is that we need to take a step back to have a look at the entire price swing, right from where the rally began. What I can see right away is that price had a long run until this point. This put our price drop into perspective. So we had the price drop. Now, if we look at another couple of sessions, price is still dropping, although at a much slower pace. Should we conclude that this is it for this stock? At this point, the first thing I do is to switch my chart to Heikin Ashi candles. Notice the difference. With normal candles, the last few price moves were uncertain, and it can almost trick us into thinking that a rebound is just around the corner. But as I flip the chart to Heikin Ashi, the picture becomes much clearer. Heikin Ashi filters out that noise and gives a smoother view of the overall momentum. And right here, it shows me something critical. Long bearish candles, which means a strong downward pressure. Instead of seeing mixed signals from my normal chart, I now see very clear, consistent bearish candles. It's way too early to jump into this trade right away. Let the market cool down, and this is why this is a very effective visual signal for traders. This simple hack in the form of these strong bearish candles keeps me from reacting emotionally. Instead of rushing to buy the dip, I now have a visual confirmation that the correction has weight behind it. One important thing to note is that price alone is not enough. I will quickly check the volume. Seeing such a high volume in a single session suggests potential institutional selling. However, the volume returned to its normal level after that session. This could mean that while the price may still be struggling, the storm might have passed. Now comes the most important question that I will ask myself. How significant is this fall? Nothing answers this better than Fibonacci retracement levels. I will add Fibonacci to my chart, setting the lowest point at the bottom of the bullish move and the highest point at the recent peak. There are 4 key levels in Fibonacci to watch. The lowest one, which is 78.6, may be too deep a retracement to recover quickly. If I have to trade from this level, I will apply additional analysis and caution. And then there is an additional level of 50%, which is also quite important for trader sentiment. The price broke through the 38.2% level and closed just below it. That's a warning signal. Over the next few candles, price hovers under that zone. It's testing whether this will become resistance or whether it can regain support. But if the price continues to close below this level continuously, it would mean that this is becoming a resistance for it. A few more candles and I can see the price drop further down to the 50% Fibonacci level. And now something changes. The stock finds support here. This is where I'll keep a close eye on the Heikin Ashi, and right here I can spot a classic signal. 3 consecutive bullish candles with no bottom wick. By the third candle, I am ready to consider an entry. At this point, I have a clear indication from Heikin Ashi, and it's coming at an important Fibonacci level. However, anyone who follows this channel would know I prefer getting Confluence on such moves. This is a swing setup, so I will have to live with my decision for weeks or maybe even months. Therefore, it is important that I don't rush into this decision to save a single session. Now, I will bring in the RSI indicator here. What do I see? A double bottom pattern forming with RSI starting to curl upwards. This is powerful because RSI often gives a leading signal. What if I used MACD instead? Can you notice the difference here? On MACD, the bullish crossover happens much later. Because the earnings drop is so sharp, it pushed the short-term EMA far below the longer-term EMA, and that will take time to recover. RSI simply reacts faster in this type of setup. Now let me share a few examples from my actual trade. In the first example, let's go back to Texas Instruments, the stock we have been using in this video. After the earnings dropped, the price dropped sharply, but instead of rushing in, following the similar approach at different time frames, it allowed me to average in at around $183 mark. From there, the price gradually recovered, and as you can see, it's now holding well above the $200 mark. In another example, the price drop was even deeper. The initial reaction looked scary, but the structure was very clear. And my average entry point for this one came to be at around $167, $168 mark, because I did a few different entries and averaged my price. And since then, the price has now rebounded to well above $187 mark. So that is how I approach the post-earnings drop. Instead of guessing whether the price will bounce or keep falling, I let Heikin Ashi, Fibonacci and RSI guide me with the decision. This way, I don't just trade the panic. I trade in a structured manner. I hope you found this video useful. Please share your questions and thoughts in the comments below.